Hey traders, Raghee here. Welcome to Charts and Coffee for Monday, June 14. Great to see you all. All right, so as always, hope you had a great weekend. Hope you spent some time away from the screens. Well, I did not take my own advice because this weekend I was working on the webinar that we've got coming up. Webinars, we got classes, got some updating tools. We'll talk about that later on, but just wanted to remind everybody, if you haven't already received the email, we've got a webinar coming up this Wednesday. Yes, day after tomorrow at 8 p.m. Eastern, 7 Central. And you can sign up for that webinar at simplertrading.com/entry. The tools that I've got running on my screen, the ones that I'm using to break down the charts from our questions, which we will get to momentarily. Those are the things that I'll be walking you guys through, as well as the way that I've been intraday trading in 2021, picking up from where we left off in 2020. All right, so let's go ahead and jump into the questions here. With the upcoming Fed meeting, will I be making any changes to my commodity holdings? Actually, no. So I am more concerned right now, and it depends on, so when we talk commodities, I'm really thinking, say, your grocery store commodities. So that would be things like corn, that would be things like soybeans, that could be things like bean meal and lean hogs. I mean, that's where I'm thinking the grocery store commodities and the inflation picture. So the pullbacks, say in hogs, are starting to look pretty interesting for a buy the dip in a double green environment. So for those of you that aren't familiar with the lingo, what do I mean by double green dip? So this is what I'm talking about right here. The structure of the 8, 13, 21, and 34 syncing up very nicely with what has been dominantly green grab candles. These are my color-coded candles you'll see in all my charts. And now we have the dip, and we're starting to get our Darvis signal firing off here, which is actually, I don't know if you can see that. It might be a little small, but get that little arrow right in there at the 21 exponential prop dot. So we've got a lot to really like on this chart. So those kind of positions, I'm not concerned about, Kevin, going into the Fed. I'm more concerned about what more vulnerable trends are looking like. So this is starting to become a bit of an uptrend in trying, not yet, in the long bond. And this is a pretty vulnerable uptrend in gold. I've got a position in GDX, and I'm willing to be a buyer on the dip in gold. But remember, GC, MGC, GDX, GLD, all these are going to be very sensitive to this fairly fresh uptrend. But I still think this is buyable. But markets like gold and bonds and the broader averages, as well as the currencies, are going to be more vulnerable to the Federal Reserve and whatever it is that we're going to see in terms of their communication. So let's talk a little bit about the Federal Reserve here. Let me bring up the calendar. All right, here we go. Bring up the calendar here. So if you take a look at Forex Factory, you start breaking down the calendar, and you go out to, there we go, and you go out to Wednesday, we've got the whole Fed shenanigans coming up. So here's our 2 p.m. Fed funds rate statement, press conference. This 2:30 becomes huge. So this market is generally going to be gearing up for really the most important day of the week. Of course, that is Wednesday, to your point. And generally speaking, I don't like to be short in front of any kind of Fed event like Fed minutes, Fed statements, or Powell speaking. It's usually a buy the rumor, sell the news. All right, so I'm not really concerned about the grocery store commodities. I'm much more concerned about volatility in bonds, gold, US dollar, and the indices, which are actually at some vulnerable spots on the chart. We've got the S&P sitting up here at potential resistance. You've got the NAS, which is in chop, also sitting at potential resistance. And this doesn't mean I'm bearish. It's just more indicative of I am never a buyer up here, right? We're always going to look for a little bit of movement lower, preferably when we have a double green, which here in the case of the NAS, we do not. So S&P pullback, it's welcome. Pullback in some of the heavily weighted sectors, completely welcome. I'm doing the weekly watch list this week. So keep your eyes open for that particular video that will be on the dashboard for all the different services within the Simpler Trading website. So if you're a member, be sure to check out this week's weekly watch list, which we'll be posting, I believe, later today. And I'm going to break down a lot of the process. In fact, here are the notes. I'm going to break down a lot of that process and then some of the levels that I am interested in. Okay, so that's what we've got going on in terms of the impact, Kevin, of the Fed. So great question. And that's the way that I'm looking at this market right now. All right, so next question is XLV, NVAX gapping up. Is XLV in play? All right, so then that takes us back to a process that everything is process driven, gang. Whether what is your playbook, right? When you open up your playbook, think about a football coach. Depending upon how the other side of the ball is lined up, or what kind of position you are on the field, you're going to have a play that you want to run, right? Well, it's no different for us as traders. The market's going to dictate what type of play we want to run in the market, of course, meaning the broader averages or the sectors of stocks and what their structure is, right? So if you take a look at healthcare, and your question was specifically about NVAX. Okay, so if NVAX is going to have an impact on XLV, it must be heavily weighted. And this is where, when I'm day trading or when I'm building out the watch list for sector secrets, whatever it may be that I'm looking at, everything's going to have this index sector stock approach. With that being said, NVAX has I think it doesn't have any significant impact on the XLV. So the answer is no. So Milky Fade, the idea here is really you're probably going to see maybe a little bit more impact on small caps like the Russell. Maybe, and I'm trying to think if there's anything that has a lot of volume in the biotech where NVAX would be heavily weighted. It's just not a mover for the XLV because it really is not in any way part of that group, right? And that's where make sure you understand that, yes, it might be a healthcare narrative, but when it comes to moving the underlying, it's really not that impactful. You've got to know what stocks are in these individual sectors. And if that's something that you're not quite sure about, again, in this week's weekly watch list, I'll be talking a lot more about it. Okay, so next up is no changes at time, FedWatch tool. Yeah, so Grogu, you bring up a great point. Grogu, I love it. You bring up a great point. So if you go to Google and look CME FedWatch tool, just Google that and you'll get the link, which is called the Countdown to the FOMC. And this is the way you can look at Fed fund futures and what they're projecting the probability for a rate hike or a cut is going to be. Now, here's the other thing. You've also right now, this is not the column you need to be aware of. This is the column you need to be aware of, meaning you want to know if that plus 25 to 50 basis points, right, BIPS as it's known, is starting to move higher as we go further out into the year, meaning if we start looking at the September, let's see here. There we go. As we go out to September's meeting, November's meeting, December's meeting, that's what you want to keep an eye on. Is that column moving up after important data points, Fed statements, speeches? Because that's where the expectation, if it starts to move higher, brings this lower and gets traders concerned about an increase in rates. We're not there yet. We're not there yet. What's really going to be much more important is the way that the statement is phrased. And there is a statement tracker from the Wall Street Journal. You can actually just Google WSG statement tracker. and see what the subtle shifts are in wording, which sentences might be modified or taken out. And it's really the messaging right now that's going to be so important. And you can actually see that play out in bonds. You can see that play out in the dollar. But it's not just what the Fed fund rate futures are saying. It's actually also the way that they're messaging about whether they even utter the word taper. You know, we're waiting to find out when they're willing to talk about taper. Not when are they willing to taper, but when are they willing to talk about taper. So as long as that's not something they're willing to discuss, taper is going to precede any move in rates. All right. So I hope that makes sense. And yes, always be aware of when those events are happening, because if nothing else, we might have that, again, what I expect there to be is a buy the rumor, sell the news type approach to that event. All right. Thank you so much, Grogu. All right. Next up is if I'm trading the Asian and European sessions, where do I anchor the V-score? So, Fernando, you could anchor the V-score at, well, you're going to want to anchor it in accordance to those sessions. So I would say 8 p.m. and 2 a.m. Eastern is fine on the anchoring of the V-score. Can I take a look at the futures, soybeans? Yeah, I'm all for looking at some of these markets, but one of the things that we've been adjusting to is actually focusing more on bean oil and hogs. And while I don't mind the pullback in ZS, ZS is behaving the way, say, corn did when it broke its trend. So this is a broken trend in here. And you can see that soybeans have been struggling with the trend since this point on the chart, since right in there. So yes, it's buyable, but it's no longer a trend. And the difference between no trend and trend is you've got to wait for some sort of support level to be reached. And it's really more about an oversold buy conversation than it is a trend following pullback. So we've been sort of not discussing ZC and ZS as much, and more ZL and hogs, because those trends are more intact. And again, we have to do consistent monitoring of the structure. This is how I look at the structure. It's one part our JT, and it's the other part the grab. So that's where my focus is at, and that really easily and color codedly tells me, yeah, this red grab candle is a little bit of a problem, but take a look here. There's my last harvest. There's my last harvest. So yeah, if I just kind of extend this out, I'm feeling pretty good about this area. Yeah, we might go down and test the 55. I mean, I wouldn't be surprised if we get a little bit lower in the range, but this is going to be a level at which I will go shopping for some long beans. So bean oil, my friend, not so much beans. All right. Okay. So what is my assessment of inflation? You know, I try not to front run the actual data. In other words, I don't want to impose my opinion on the market. What I want to know is when CPI, PCE, GDP data is coming out. When do we have the FOMC speaking, etc. I know that, you know, look, I could probably make arguments both ways. You could probably make arguments that some of the CPI data has been a little bit transitory because of just the unusual amount used cars have in terms of weighting. I think it was many charts and coffees back where I talked about how over the decades, the way in which the CPI is calculated, the actual data that makes up the CPI is very different. So if you look at a CPI from 15 or 20 years ago, it's very different than the CPI now. So to talk about historical CPIs is actually inaccurate. So what we have to remember is if the composition of the CPI weighted other factors differently than what we're looking at now, it's really a different data point because it's a different data set. So then I want to keep in mind that if the Fed is able to convince the market participants, meaning the broader averages, that this is really transitory, then so be it. Then they'll start looking at the points at which would sort of justify that transitory opinion. And I think probably used cars are the most legit way to say the Fed could be right. You look at the last two CPIs. the one that blew the number out of the water and the one that came in pretty much in line. If we stay in line on those CPIs and PCEs, the market's not going to care about reality, because the reality really is whatever the Fed says it is. And then the monetary policy that they're following that sort of makes it true, right? They control all the levers of the market. And that is the asset purchases and the money printing. So the Federal Reserve and the wake that they create really is the macro, right? And yes, bonds may say we disagree, and bonds may have lots of opinion about whether or not inflation is transitory or not. But the fact of the matter is bonds could be wrong for a great deal of time before they're right. And oftentimes when it comes to bonds being right, it's very much a way in hindsight thing saying, oh, look, bonds were doing XYZ 3, 6, 1 year, whatever, 3, 6, 12 months before the market turned over, that kind of thing. So be careful. Be careful right now. My assessment going forward is which is the same assessment it is all the time. Find the relative outperforming corners of this market. There are plenty. In fact, when I have the webinar on Wednesday, even if you're thinking, I don't really day trade. Day trading is a part of everybody's strategy, because if you're putting in an order and you want to put in your order in the best way possible, even for a longer term time frame, having a little bit of a day trading understanding of flow is only going to help. If you are a day trader and you're struggling through 2021, my 2020 is not quite on track for 10x, but it's probably on track right now for 8x for 2021. And the reason that it's not being derailed by the action is because I'm still focusing on relative outperformance. And that's the corner of your watch list building that a lot of folks struggle with. They fall in love with certain narratives, whether it's a macro narrative or whether it's just they want to trade tech all the time. The fact of the matter is there's a lot of corners of this market that are behaving like 2020 did. So, for me, are there things that are relevant to the inflation narrative? Absolutely. But if I can't find those double greens, I'm going to be really wary. There are plenty of those in this market. And so if we're going to have transitory inflation, then you ask yourself, what's going to benefit from inflation? What's going to benefit from, if the Fed is wrong, what's going to benefit from inflation? If the Fed can continue to convince the market that it's transitory, well, that's going to keep certain indices on track. And that's where I want to get optimistic and opportunistic. So what I'm hoping you guys are taking away from that little explainer is, whether you're trading short-term or long-term, index sector stock and the process by which we look at relative outperformance will always be valid. And then here's really something that's going to be quite different with what we'll be discussing on Wednesday and what's ultimately going to be in the class. How does Darvis impact us in a way where we have more clarity now? You can see we have a whole different level of clarity with the Darvis because of the signals. And here's really what's important. The daily time frame. A lot of day traders ignore patterns and signals from the daily before they venture on over to the 1 or the 2 or the 5-minute chart. And that is why I think a lot of traders are struggling through this year, because they don't realize what that larger trend does to impact the clarity and the directional bias even of their short-term time frame. So there's a lot that, in terms of what we're doing right now in 2021, has to be a little bit different and tweaked than what I did in 2020. And one of them is just accepting that there could be a reality where, yes, you've got energies moving higher and inflation markers all over the place, and yet the Federal Reserve is saying something else. Doesn't matter, right? We have to be able to break the markets down to see what they are responding to, not what I think they should be doing, right? And I think a lot of traders who are not doing that are struggling a little bit in 2021. You don't have to struggle. It's not that different a market. It's just not as broadly the buy everything market. And yes, the Federal Reserve has far more influence on this market than it had in 2020 at this time last year in some ways. Different influence, right? Because the market's sort of waiting for the shoe to drop. Yeah, it's a little bit of a scary environment. I do get it, but it's very tradable. It's very tradable. And with that, I will see you all for tomorrow's episode. Thanks as always for being a part of Charts and Coffee. For those of you that are wondering about gold, I am still quite bullish gold. But remember, historically, if we want to step back and look at the overall markets, we're going into the week of triple witching, quad witching, whatever you want to call it, lots of witches. And so remember that this is sometimes a choppy week. Historically, this has been a choppy week. Embrace the chop, shorten the time frame and be more nimble this week. And then remember that some of the dips that you might be waiting on, they could have another shot this week. But I'm not expecting just some collapse of the market, but we do have an interesting week. We've got the triple witching. We've got the Fed on Wednesday. And so if we think that the pit bull low was put in last Wednesday, I am expecting a little bit of chop to slight bullishness going into this week. But it's not across all the markets. The little bit of chop could be a dip that we could buy, and the follow through going into the next week is really where I still want to position myself long overall in the relative outperforming corners of this market. And if this market's making you nervous and you're concerned about session after session follow through, shorten the time frame. All right, gang, be good to each other. I'll talk with you soon.